Hi everyone, John Boardman, CEO of Ballast, joined today by Brian Burton, who is our Director of Portfolio Strategy and Partner, and Amy Reynolds, our Chief Operating Officer and Partner. We like to do these videos from time to time just to talk about what we're working on for clients. Getting a lot of questions these days I should say, about the economy, the markets, how things have behaved. We thought midpoint of the year, great opportunity for us to sit down and talk about a few of these areas. So let's start with sort of the economic backdrop and go from there.
Sure. So let's maybe talk big picture and kind of narrow it down from there. So I think a lot of questions right now that we're getting is, one, how's the market doing as well as it is? Two, what's going on with this recession that we thought was going to happen by now or may still be happening? And then three, what's the economy doing? So I think big picture, I think it's important that people realize our GDP is still okay. It's good, especially with where we are. The world GDP, I just made some numbers here, 2.7% in projected for this calendar year, 2.9% real world GDP. US GDP 1.5 to 1% projected this year, next year. So those numbers, are a little lower where they have been this past 10 years or so. But they're not negative, they're not horrible. It's not this bottom falling out of the world or US economy like everyone's been talking about. So I do think that is kind of the baseline of why we're okay, and it's not this run for the hills type mentality where if you watch the financial news or media, they're gonna scare you. I do think also, as we look at that, we're seeing decent growth out of non-US countries as well. China, whether they're emerging or developed, I don't know how you qualify them anymore, but China, Brazil, projected to actually do pretty darn well in their GDP. So I do think the backdrop, not getting too narrow into all the details, we're still okay.
Yeah, that's a great point. You mentioned China, Brazil, India. They're blowing the socks out of it right now with their economic growth, and I think they're probably the next China. They're probably 20 years behind China, but definitely one to pay attention to. If we move to corporate earnings, still okay. We're expecting a year-over-year decline of 6.5% as of last week. But if you look forward, third quarter we're expecting just under 1% growth in corporate earnings, and then fourth quarter expecting to bounce back 8% growth in corporate earnings. So for calendar year 23, looking at earnings growth of right around 1.1%. So to Andy's point, certainly not the end of the world. There's a lot going on right now in our economy.
Yeah.
A lot of positives as well to really look forward to.
There are a lot of the conversation, the economy just doesn't have a direction right now, and I think whenever it doesn't have a direction, positive or negative, people start to question, is this before we have some sort of a severe downturn? And if you look just at households, jobs are still attainable. There's still a lot of openings, and that gap's closed a bit, but at the same time, if you want a job today and you're skilled in that field, there probably is an opportunity to gain employment. And housing. Housing's been a big problem leading into this, because the market's so tight. We have a inventory issue right now, but for homeowners, it is still, we're seeing home values continue to rise, and that has, I think, helped the health of the consumer for sure through this period of time. So there's a lot of sort of factors working against each other, but jobs and homes being sort of the core financial pieces of most families' financial picture, still in pretty good shape. I think that's one of the reasons maybe we haven't seen some of the weakening that we had been projected this year.
Yeah, absolutely. So job growth, wage growth. Wage growth running around 6% right now, and with inflation down now around 4%. Those are real gains. So those two things are supporting the housing market and continued improvement in home prices, and with the unemployment rate where it is, that's a huge factor.
No, I agree. I think going back to the comment you made about direction, I do think that the direction is so unknown right now. And I think that's why this recession term largely has been able to hang around. Whether we're in a recession, we were in a recession, or we're going into a recession, I don't know that matters as much. But what I think does matter, and when I look at some of especially the consumer stuff, I look at that as the consumer's looking for that direction too. If you look at the state of the consumer's doing okay. There's a chart that I follow that has consumer debt relative to disposable income. And the Q1 numbers just came out. Everyone was expecting it to go up and go up substantially. It actually came down. So, you look at that, you look at the savings rate, which isn't as high as it was, but it's still at a decent rate. You look at the ability for the consumer to go borrow more to plug holes and whatnot, and that number is still relatively high. So, but what we're seeing is the start of a change. And to me, I look at that and kind of think the consumer may be getting past this post-COVID, just spending spree when they had plenty of cash and they were tired of being cooped up, and now we're getting a little bit back to reality and trying to figure out what the consumer is going to do with that. I think is a big part of this lack of direction of where the market's going, where the economy's going.
Consumer behavior. I think there's sort of a recency bias around the idea of a recession or some prolonged economic contraction. COVID was severe, very short-lived in that recession, and then people remember the financial crisis very vividly. Those were severe. It was obvious just in the way that the world was operating at that time that we were in a recession. If you look back in history, though, I think the U.S. has been through something like 48 recessions in its history. Some are a lot smaller than that and really almost unnoticeable. Whether that plays out in this scenario or not, we will find out. But I think what financial media, what investors, what just households, when they hear recession, the most recent examples of that have been pretty severe blows. And it's very possible that we experience a recession and we don't actually know it until the Bureau comes out and says, we were in a recession 2 quarters ago, up until this past one, and we move on from there. And this hard landing, soft landing debate keeps getting brought up. And I think it's important because, a soft landing would be less impactful to people and probably, like I said, somewhat unfelt until we're told that's what it was. Whereas a hard landing, I think, I saw Stanley Druckenmiller refer to a hard landing as, net of 6% unemployment, 20% reduction in corporate profits, and then a couple other factors inside of that lasted at least 6 months. And so he wasn't looking at it from traditional terms, but sort of the actual real impact on people. Some things would have to change, I think, from the current backdrop for that to play itself out. And so most of the, I think, predictions around recession are Q4 of this year, Q1 or Q2 of next year. But considering the backdrop, we would definitely have to have some change in the status quo, I think, for that to play itself out in that regard.
And a change in a world where the world's different. And, we're looking at the new new business creations last year. 5 million new businesses were created last year. That's a lot.
Yeah.
So, how does this recession occur? Maybe it's a recession in different industries or different jobs or different age groups, and it kind of moves fluidly among those things as interest rates change, as the workforce continues to age, as these new job creation or new business creations, they get a little bit more experienced and maybe they can't cut it, or maybe they do it for a while but then they need to make a change. So I do think getting back to that direction comment, there's just so much unknown about where we're going, but the data continues to show there is some unknown, but the data is not horrible. And a lot of the media focuses on the horrible side.
The data may be telling us that the Fed's accomplishing exactly what it was hoping to accomplish, which was just to convince people spending money that they needed to back off a little bit. Walgreens reported the other day, Target's said similar things, just little signs about buying decisions that are not they're not going to shop. They're still going to shop, I should say, but their purchasing decisions in stores, as simple as they may be, could result in a 5% or a 10% reduction for a store just on, name brand versus generic, or, going out to dinner and buying a glass of wine versus a bottle of wine. Those little things that can trigger an economic pullback. It just may be a little bit more nuanced and less noticeable.
Right.
Yeah.
So it's obviously had an effect on the consumer in that regard. But it's also the Fed's policy decisions have had an impact on corporations as well.
Right.
We've seen a lot of cost-cutting measures taken by these companies, and it's not so much the Fed wanting companies to cut positions that are that are already there. It's more so about them taking jobs off the table that are available, and I think that the Fed's actions have in fact done that. And to this point, it hasn't been with too much scar tissue, if you will.
Talk a little bit about what you anticipate the Fed doing going forward. I mean, they've done a lot. How do we think that they're going to move forward, and with what type of care with the decisions they make?
Yeah, I mean, with kid gloves for sure. Rates are currently at just over 5%. The Fed did pause at the June FOMC meeting for the first time in quite a while. But it does sound like they're pretty intent on raising rates further. It looks to me like now the probability of a June hike, or I'm sorry, a July hike is 77% based on Fed futures. So that looks pretty baked in at this point, a quarter point in July. And then Powell left the door open for another quarter point hike at some point in this year. So whether it's 5.5, 5.75, I don't think that really matters that much. I think the most probably important thing is that the Fed is not likely to pivot and start cutting rates this year, which at one point, if you recall, the markets had pretty much priced in
2 cuts, right?
2 rate cuts in
Right.
23. So that appears very unlikely, absent some type of major economic contraction or some more turmoil in the banking system. So it looks like probably 2 more rate hikes to get to their terminal level, meaning they'll quit raising rates. And forecasts are actually now looking at rate cuts in Q1 of 24. So that's kind of been pushed out a little bit. We would still have to see some type of economic contraction, job losses, in my opinion, for the Fed to cut rates. They're adamant about bringing inflation down to their 2% target, and it's getting to the point where inflation is becoming very sticky around this 4% level. So, in my opinion, rates will probably stay elevated for some time.
I think bringing the inflation down to 4 was a whole lot easier than it will be going from 4 to 2.
Absolutely.
And even though that's a smaller nominal amount, it kind of feels to me like the Fed was doing as much as they could do without wrecking the economy previously, and now they're going to be kind of taking the other side. They know what they need to continue doing, but do it very carefully, not to wreck the economy.
Right. It almost feels like the actual rate where we end up is far less important than the narrative continuing to be pushed that rates are going to stay high. And Powell and the Fed know that if they pause for too long, that typically precedes an eventual cut. And so
That's right.
It's about maintaining that narrative as consistently as possible to keep behaviors where they are. I mean, he's worried, I think, and they should be, that if they back off, and then we're just going to reignite the inflationary flame that we're dealing with. And they're in a tough spot because, and I referenced Druckenmiller a minute ago. I mean, one of his reasons for predicting that we could face a tougher recession is that what the Fed's done to date has effectively worked. You could argue, I think there were some other factors at play, like the supply chain healing and other things like that. But essentially, that the Fed is a little bit out of bullets. That the impact of rates increases from here just do not have the level of impact that the previous rates have had if he keeps moving forward.
And it could potentially cause people to really change their behavior. We were talking yesterday, 3 or 4 different clients who, making the right decision, maybe not doing the home renovation, maybe not, doing or paying for things out of cash rather than borrowing, and just naturally, while a 6% mortgage may not sound that high if you look historically, but when you're comparing it to your neighbor who has a 2.5 or a 2%, 15-year, it may feel like, well, gosh, that's just a really irresponsible thing to do. So we're going to pump the brakes. And too much of that, we are a consumer-based economy.
Oh, yeah.
Too much of that could put a screeching halt on things as well.
Yeah. Let's talk about markets. We invest money for our clients. They have a lot of questions about how the market's behaved. I mean, it's been a strain. I mean, a lot has happened actually in 6 months, even though the sort of net return on the markets is, not all that impressive. There's been a lot going on. So I mean, kind of what are your thoughts on what the market's done year to date, and what's performing and where are we lagging?
It has been a very interesting first half of the year, coming off 22, which was a pretty tough year, particularly on the NASDAQ and tech stocks. Growth so far in 23 has far outperformed value. Kind of a mean reversion there, with growth stocks getting hammered last year. Growth's up like 26% year to date, while value's up just over 2%. But within that, it's even a little bit more interesting than that. It's the fact that market breadth, not breadth, but breadth with a D, is very weak this year. So that means that the largest stocks in the S&P 500 are carrying all the weight. So in fact, the top 10 largest account for 90% of the market's return year to date. So I think Kramer's dubbed them the Magnificent Seven. He always has some kind of...
I heard the Elite Eight the other day.
Elite Eight, yeah. But you know who they are.
Yeah.
Apple, Amazon, Google, Meta is in there now, Tesla, NVIDIA. So anyway, your huge tech companies for the most part are carrying all the weight. At the end of May, only 15% of stocks in the S&P 500 were beating the index, which is a historic low.
Yeah.
So it's almost kind of a store of value for investors right now, is looking at these huge tech companies that are extremely profitable, and finding those instead of your traditional value stocks where you would typically run in a kind of a recessionary climate. Folks are actually investing more dollars in these highly profitable tech companies. So it is kind of a new era at this point.
And if you look outside of those handful of names, every other asset class is far behind.
Yeah.
Whether it's small, mid, emerging, developed. So it's definitely a store of value.
Mm-hmm.
I like the way you said.
Yeah, I mean, and the concern there is that, if you just look at the valuations on those names, they're getting lofty again, and I think they've benefited too from, there's really not any tailwind right now other than this AI story.
Sure.
And it gets tossed around, and I was listening to someone the other day on a podcast saying, if you're a tech CEO, you might as well just throw the term AI into your quarterly call, because the market's responding so positively that even if there's no understanding of how you're going to monetize AI, the idea that you're working on it. And so there's a little bit of a desperation in the market to find something to cling to that is a positive story. And so I think good news is that those have performed well. Bad news is I think they're getting a little expensive. And if you there's clear separation as far as if you're just looking at traditional valuation metrics. There is a lot of the market that looks really cheap,
Right.
particularly relative to those handful of
for
names.
sure.
Yeah.
Staples, healthcare, materials look far undervalued.
Yeah.
And tech, obviously looks a bit frothy.
Financials kind of tough to tell at this point.
Financials are still, there's still a big question mark around the banking situation. It's definitely not over. There's, we've still got probably a few tough times ahead for the banks until we get some, final regulations and kind of figure out how the banks are going to be profitable.
Not as scary as we thought it would be.
No.
It had the potential to be. But,
a lot of it.
Definitely a lot of unknown there.
Yeah.
I want to talk a little bit about politics. Who are you voting for? No, I'm just kidding. Politics, I think, over the last 10, 15 years have just gotten increasingly tied to how markets react, but particularly on a daily basis, maybe not over the longer term. I mean, we just dealt with this debt ceiling issue, which, created some drama, temporarily solved. I don't think the cause of the issue was addressed, but there was a patch on the system. Any comments on the political backdrop right now, and should investors be worried about it? We've got a presidential election cycle that's ramping up. Any thoughts?
I mean,
without upsetting anyone.
Yeah.
I'll preface this, I'm politically agnostic. I think the thing that I always keep coming back to with the whole politics thing is it will drive the market in the short term, without a doubt. Somebody will do something, say something, some political party will come out with a stance, whether it's taxes or whether it's spending or whatever. But big picture, the thing I always come back to is and we saw this in COVID, we got a big ship that we're on. I mean, the U.S. economy, it's hard to make big changes. So, a president may be able to make one or two meaningful changes during their presidency. American Funds has the best study out there. It's in our commentaries. I'm sure we can link it on here. It doesn't matter during a 4-year presidency pretty much what the makeup is, who's the president, or how Congress and Senate's divided. It's an 8 to 10% return across the long-term average of all those makeups. So I think we give a lot of weight to who's in office, and it is really important, but ultimately, there are a lot of other factors at play. So that may be the
a president
saying that.
A president in general, in 4 years or even 8 years, you could argue they're sort of dealing with the backdrop that was created and the lag effects from policy that happened previous. That's not always the case, but I think there's a pessimism around politics just in general, and I'm not talking one party or another, just in general, that I think has had an effect on American optimism. I think that there's no question about that, and there are long-term issues that unfortunately, I think primarily being the debt of this country and how we're going to address that and actually deal with the problem at hand, which is entitlements, and it's Medicare, it's Social Security, it's defense spending, and they are so difficult in our current political environment to discuss, because you'll get branded as the person that's trying to cut your benefits or cut our military spending, and no one wants to be labeled at that. But in this most recent debt ceiling debate, in reality, they were only talking about 15% of the budget, and to do that and then try to sort of patch the hole that they were dealing with, it's just very, very challenging. So the optimist in me says that we will have a gregarious leader that comes along and can convince the American public that is in fact possible to do. I think at least widely supported.
And those are far more important than whether it's a Democrat or a Republican.
No doubt. Yeah, it's probably going to have to be someone that can appeal to both parties, to deal with that political situation. I don't think the markets this year really have. There's a great deal of politics that are priced into it that I can tell. And at this point, it's it's hard to tell really who's leading in any of the primary, let alone the general election, and where we don't even know the candidates yet. Right. So I just thought I'd end it on just a really awkward. So do you have any other comments to make before we kind of wrap? You want to wrap it up?
I know. Thank you all for listening, and hopefully you all have made it this far. If you guys have any questions, always feel free to reach out to us. We love these types of conversations, and always be thinking about what's going on in the market, the economy, and then how that affects your personal situation. Good planning in any type of market or economy is always beneficial to people. So thank y'all for listening.
Thank you.